Big businesses look to us for specialist insurance solutions. Do you? 86 of the top 100 JSE-listed companies trust us to protect their businesses.
Hello and welcome to the second in our series of programs on the role of insurance in the economy and the factors that are affecting insurance companies. Over the past decade, there's been an increase in the frequency and severity of weather-related catastrophes, which have resulted in an increase in commercial and corporate property losses. So what's next for the industry? Today we look at the risk exposures facing commercial and corporate property. I'm Stephen Gunyon. Joining me for today's discussion are George Bishop, CEO of Willis Towers Watson South Africa, Belhassan Tonat, the General Manager of Munich Re of Africa Short-Term Insurance, Andrew Kutz, Head of Intermediated Distribution at Santam, and Bernie Ray, the CEO of Emerald Africa. Welcome all. And Andrew, I'll start with you perhaps, because Santam was hit hard with claims after the wildfires and extreme weather in the Western and Southern Cape earlier this year. Was this unprecedented in terms of the damage in claims?
Absolutely. So we picked up almost 800 million rands worth of losses in that event. And I think when we look back and we've unpacked what actually happened in that space, you almost wanted to say it was improbable that it would happen. Two big fires caused those damage, what we call the Western Fire and the Eastern Fire. The Western Fire is what hit Knysna itself. And having looked at it now in detail, it was caused by a lightning strike on the 9th of April, 20 kilometers away, in what is a very low lightning density area to start with. The spread of the fire was driven by a wind in a northwesterly direction that typically happens 14 days in a year on average. So very unique wind conditions, supported by a very unique flow of the ridge to actually get the fire to spread there. And the actual conditions on the 6th and 7th of June were also unique in that we had a difference of 14 degrees in temperature between the maximum on the 6th and the 7th, together with a 27% shift in humidity, and the combination resulted in a significant push of the fire and obviously the speed of the losses. And the fire, it moved so fast, it jumped the Gokama River, jumped the Knysna Lagoon, jumped the Knysna Head. So something like that, the combination of weather events, and this of course also when the condition of the vegetation itself was obviously dry, significantly drier than the 18-year forecast we look at. So almost a really unique set of circumstances that result in really significant losses. We paid claims on 1,500 items in that Knysna fire. So it was yes, you could say it was certainly a tough period. And the experience of the people, obviously, and our customers and the people affected there was just absolutely horrendous to a scale that we really haven't seen before.
Of course, Andrew's customers are very different from your customers, George. Were your customers also affected by those events?
No, we at Emerald Africa insure the larger corporates, and generally speaking, in Knysna we had the single ownership of the lodges and houses. As it turned out, we didn't suffer any significant losses from the Knysna fires. That doesn't mean that we were spared all of the pain of the 2017 natural catastrophes. We were very heavily involved in the KwaZulu-Natal floods, which occurred last month. In which several of our insured businesses were hit by flood.
In events like this, Belhassan, how is the risk shared between insurers and reinsurers?
Yes, definitely. Actually, we say that the role of reinsurer in the value chain of risk sharing is actually, it comes at the very end of the chain. And usually for the big catastrophes or also for the big losses, the part of the reinsurer is actually has the lion's share of all the losses. Just to give you an example, for example, in the United States in the last 3 hurricanes, so we would say the share of which is picked up by reinsurer would be in the range of 50 to 60% of the whole losses. The share of the primary insurers, or what we call primary insurance companies, would be in the range 20 to 25%. And this gives you actually a range, so what is picked up by insurance companies and what is picked up by reinsurance companies in such kind of extreme events.
Of course, if you're at the end of the chain, then of course you're at the beginning of the chain, George, because you're actually the person who brings those clients to the insurance companies. Were other insurers as quick as Santam to pick up the bills?
I think there were. Well, what you have is lead insurers on these big property programs who set the terms of the placement. So when there's a claims like we had in the KwaZulu-Natal area, you would go to the lead insurer like Emerald and negotiate the settlement of that claim. There would be a number of other insurers participating as follow markets who would then follow the terms of the claim agreed with the lead insurer, which could be Emerald.
How, Andrew, does this put your models out of sync when you do have massive claims like this? Because you obviously model ahead, looking at scenarios going forward. Have you had to change your models?
I think we are definitely seeing a fundamental shift in the underlying risk environment. So I think there's no doubt that that's there. Weather is certainly a cause of it. I think our economic condition is another factor. So whenever we stress test models, definitely you would model a storm like this. We would model a hailstorm in Gauteng at 4 o'clock on a Friday afternoon when the highways are full. So you always stress test your model, and it's built into how you go about rating. But certainly, when it comes to the day-to-day practice, it's not something that we see commonly occurring. So that's where the value of your reinsurance programs are important. So you want to take the spikes out of your loss ratio so that you can carry and manage your pool almost on a standalone basis. Okay. What we are seeing, though, what we have certainly seen on the property side, is that we haven't been able to, over a number of years now, we've been growing our premium pool between 6 and 8%, typically inflation-related adjustments, but the risk on the ground hasn't been growing at that. Firstly, property inflation, building cost inflation has been growing typically in double digits over a period of time, and the combination of the increases in premium lower than the risk growing on the ground has meant that we actually had rate erosion over a period of time. So the premium pool now that exists to manage the loss events has become smaller and smaller and smaller. And this is now what we're seeing is now creating the bit of the where to from here as an industry. The premium pool is not now big enough to actually manage the exposure we have on the ground. And I guess it's a number of factors. There's the economy I've mentioned, but there's also the fact of the uniqueness in our South African market. Little things like the ability of fire departments to respond, water pressure in aging. We reduce water pressure to manage water flow, but now, of course, when you want to put out a fire, there's not enough water pressure to make the sprinklers work. So you end up with this compounding effect where less economic availability of funds to spend on risk management, less ability for local municipalities to respond to the event at the time, and of course then the weather impact on top of that has created this environment where it's really tough for clients, for brokers providing advice, and for insurers and for reinsurers in the value chain at the moment.
Can't you just raise rates, George?
Well, as a broker, that's not what we would like to see happening, because our clients are paying away premium instead of maybe retaining it. What our clients should be trying to do is self-insure the high frequency and low severity events, and then buying catastrophe cover from the insurance market, who then buy it from the reinsurers. I think risk management's a very important practice that commercial firms need to embed in their businesses, and through the good times spend money on mitigating their risk exposures. I mean, there are major fire exposures, but what happened in KwaZulu-Natal or in the Durban area was a massive storm that created huge flooding, massive wind damage. There's not much risk management that can be done to prevent that type of unique event that came through. So, the risk management focuses on a number of areas: fire damage, machinery breakdown, security, safety and health. Environmental is another huge area.
I mean, Bernie, do you think because rates have been soft, companies have taken the easy routes, taken more cover, and not applying enough risk management within themselves?
Yes, I think perhaps that's an unintended consequence of the softening of rates, that risk managers haven't had to put their hand in their pocket to pay for expensive risk management and improvements to their premises, for example, when it's easier and cheaper to just simply pass the risk on to the insurance industry. That, to my way of thinking, is going to have to change. I see the future for insureds that want to access good capacity at a reasonable price, needing to really look very hard at their risk management, because those insureds that do so will be able to get good product. Those that don't may find themselves uninsured or partially uninsured.
And of course, you face global pressure because it's not just the disasters in South Africa. You've had to deal with hurricanes in the United States, all sorts of disasters over in the Far East as well.
I do agree with Bernie saying actually that the rates have been actually decreasing the last 8 to 9 years almost, and this is actually mainly driven by a benign loss activities, usually in the natural catastrophe areas, be it in South Africa or also outside of South Africa. What we have seen in 2017 is actually a combination of a high frequency loss activities in the United States, which is actually the biggest insurance market, and also in South Africa with the Knysna fire, the Gauteng and KwaZulu-Natal storms. From our perspective as a reinsurers, we do believe that what happened in 2017, it would qualify actually for the costliest loss year in the last 20 years. So we have seen actually losses from the 3 biggest hurricanes in the United States amounting to $100+ billion in terms of insured losses. And this event actually cost us a lot of damage to the insurance and the reinsurance market. So it's not actually an earning event for certain reinsurers, but also a capital event. Just an example, maybe give you a benchmark figure. So for us, Munich Re, what happened in the United States is costing us 2.7 billion euro in losses, which is the equivalent actually of 90% of our last year's earnings. And it's actually roughly 8% of our market capitalization. So we do have the financial strength to overcome this hurdle, and we do have also built up some reserves to face this. But the problem is in the last 8 or 9 years, where the rates were really bottom rocket, that the reserves which you have built to face such events are not good enough to really cover for your losses in such amplitude. The other thing which I would like to come back to you, Andrew, when you said that we do have models for each and every peril. That's true maybe for the, I would call it the yearly recurring events, be it hailstorm, be it storm, be it an earthquake from time to time. But now we have seen also a new wave of new kind of events, like the bushfires in Knysna, which is very hard to model from a scientific point of view and also from a reinsurance point of view. So we don't have enough history to build up models, and we don't have actually a high frequency to stress test the models. So there we are left, I would say, with a new exposure, which we have to face when it comes. And we hear that Santam has paid 800 million, and other companies has also paid enough money to this event. But how do you model, how do you price this new exposure is actually the big question mark. And then the second question mark would be, how is this linked actually to the climate change? Do you believe that we will have in the near future other new events which we have not seen before? Or do we have maybe higher frequency or high severity in events which we have seen before? Or this actually still to be discovered.
George, do you see insurance companies less willing to take some of that risk, so potentially with your clients, when it does come to specific events?
We haven't seen that, Stephen. What we are seeing is an increase in the pricing for that particular type of event or that cover, or more stringent risk management standards to try and mitigate the extent of those losses. But it's very difficult when it's like a Durban storm damage that we saw, or like the Knysna as we've spoken. So, you know, at the end of the day, insurance pricing is cyclical. There are many more years of low pricing. These peaks have been fairly spread out, but maybe with climate change going into the future, they may be more frequent. I mean, the other issue we deal with at the moment is the drought in the Western Cape, which affects the supply of water, which then puts the performance of sprinkler protection and all of that makes it almost non-existent, really. That's another matter to deal with, but if there's no water, there's no water. So, you know, at the end of the day, for the normal events that take place, as been mentioned, risk management is what buyers of insurance need to be focusing on through all the time. And if they have a well-managed risk, it's also going to put their business in a better position, because you don't get fully paid out when you have an insurance claim either. You know, you got lost markets to recover. So people need to avoid major catastrophe losses if they can.
Okay, we're going to a short break. When we come back, we look at whether the industry is taking a more proactive approach to risk management. Don't go anywhere.
34 countries, 75 innovative risk solutions, 99 years of experience. It all adds up to being the largest general insurer in Africa.